Hi, hello and welcome back to my ESG channel. Well, today is actually chapter 9, so this is the last chapter of the ESG course, so we are now reaching the end eventually. And I don't know whether this is the first time that you watch this video, but if that's not the case, and if you have also watched the videos in the past, then well, I hope those videos are useful. And again, well, before going into today's topic, could we have a look at the key issues that we mentioned last time and see how many of them that you can remember? Okay, this is chapter 9. Now here learning outcomes. Chapter 9 is a lot shorter than the previous one. So this episode will be a lot shorter, unlike the 45 minutes one that we had last time. Okay, so this is the first learning outcome. Explain why mandate construction is of particular relevance and importance to the effective delivery of ESG investing, linking sustainable investing to mandate, defining the sustainable investment strategy. Well, for a start, I think we need to understand how to construct a mandate so that the fund managers process or approach aligns with their client. So the first thing is to clarify client needs, defining the ESG investment strategy. So firstly, the clients should be clear about their needs and set them out in a clear statement of ESG investment beliefs. And this kind of belief may be expressed in a so-called SIP, Statement of Investment Principles. There actually were certain regulatory aspects of this SIP. For example, in the UK, the Occupational Pension Scheme Investment Regulations 2005 have required pension schemes to set out in the SIP their policies on how they consider financially material ESG factors and the extent to which they undertake stewardship. And then the new reporting requirements in line with the EU Shareholders' Right Directive 2, I hope you still remember this, will reinforce the same sort of approach. So the next step in mandate construction will be fully aligning investment with clients' ESG beliefs. Ensure that investment beliefs are reflected operationally and the funds manager's investment approach, such as in terms of ESG integration and engagement. So it's pretty much, firstly we understand what the client wants, and then the next step will be how the client's requirements can be operationalized. And then in this part, we're fully aligning investment with client ESG beliefs. That can require a clear framing of basic expectations, including such issues as appropriate ESG screening approaches. The next step will be developing ESG-aware investment mandates, and typically this will be via a so-called RFP, request for proposal process. And then tailoring ESG investment approach to client expectations. And finally, holding managers to account via performance assessment, such as monitoring meetings between the client manager and the manager's measurement and report of this ESG performance. And then, as we are going to see a bit later in this chapter, holding managers accountable doesn't mean that if there are say underperformance or outperformance, then we actually have a lot of concern with that. Because this not really the kind of the focus of ESG investing. Because ESG investing, we kind of look at long term, and then should not be too worried about the short term fluctuations, and we'll revisit that a bit later. So learning outcome number 2, explain how ESG screens can be embedded. And for this part, The chapter actually focuses on an article from McKinsey, which is called From Why to Why Not? Sustainable Investing as the New Normal. And then firstly, according to this article, there are two fundamental questions that asset owners need to ask in developing their ESG investment philosophy. So the first one is, are ESG factors more important for risk management or value creation? So if the main intention is risk management, so the approach will be mainly exclusion or engagement. And then if the objective is value creation, then the approach will be to overweight the portfolio with companies or sectors strong on ESG related factors. And then the other question, according to McKinsey, will be what ESG factors are material. And according to this article, it says these factors are often influenced to some extent by exposure to asset classes, geographies, and specific companies. For example, governance factors tend to be especially important for private equity investments. So to be honest, well, this is not new. We actually covered this up in the earlier chapters. Okay, well, the article in McKinsey's article has got a table like this, and then, well, this is examinable material, so please pay attention to this one. But then, well, actually, if you look carefully, then the content of this table has been covered in the previous chapter. So, but then, so it is kind of like a summary of what has been covered. And I think for this table, we can break down the items under what, why, and how wordings, and then what would be investment mandate. So that means that what should be achieved. So under investment mandate, there's consideration of ESG factors, including prioritization and targets. So why? That's pretty much the so investment beliefs. That's why we want to do ESG investing or sustainable investing. So under this, well, the elements will be rationale for ESG integration and material ESG factors that we need to decide, and then how to operationalize the sustainable investment practices. So there are 4 aspects of this: tools and processes. Tools will include negative screening, positive screening, and proactive engagement. Well, we actually covered this in the previous slide. Resources and organization. Well, resource important because actually, well, engagement is quite onerous, and then one has to prioritize. So therefore, under this item, we've got ESG expertise and capabilities. So it's pretty much, well, internal or external expertise, integration with investment teams, and cooperations and partnerships. So cooperations and partnerships, they will include things like, say, collaborated approach with, say, other peer investors. And we actually I think we actually covered this in the past under the engagement and stewardship chapter. Performance management, review external measures, and also follow on internal measures. And then public reporting, the main elements will be accountability and transparency. Okay, third learning outcome. So under this learning outcome is pretty much to find out what we need to figure out on a manager's approach and capability via the RFP process, to pretty much to understand things like voter engagement, decision making, and the screening process. And we've got this POSA, Pension and Lifetime Savings Association, which lists out the areas that asset owners should test managers to demonstrate the value that they can bring through their ESG work. The first one, understanding how the manager sees stewardship and engagement and what its main drivers for actions are. This includes how consistently that philosophy is applied across asset classes and geographies. And then second, seeking confidence in the process by which the manager's objectives are set and progress against them is monitored. And understanding how the manager allocates its engagement efforts between different forms of engagements. Right, and then what do we need to find out in the RFP process? So the first one is about investment integration. So under this heading, the class key questions will always be around the investment decision-making process, which the manager should demonstrate as being robust and replicable over time. So that includes an analysis of the formal process and, in particular, how ESG factors are integrated. And then a discussion of the process as it has been applied to individual assets, including how assets questionable from an ESG perspective might be included in the portfolio via such process. So it's pretty much like a case study. The other thing we found out in the RFP process will be about engagement and voting. So questions that are to be asked by the asset owner will be: who does the stewardship work? A dedicated stewardship team or by the portfolio managers? And then second is, well, about resources that we just talked about. Because the stewardship or engagement process can be quite onerous. So we need to know how much resources required for stewardship or engagement activities. And in particular, as we've also said, because resources are limited, the asset owner will need to understand how the manager will prioritize and how this might be best be reflected in the manager's program or activity or maybe so-called schedule. So in other words, the client should always ask how the manager ensures that the use of its resources is most effective. And about proxy voting. In certain cases, the asset owner will want to do their own proxy voting, but then in most cases, this will be done by the manager. And then if this is done by the manager, the asset owner will want that the way that the manager votes will be consistent with kind of what they want. So the questions that need to be asked will be, how does the fund manager vote in general? And by what process does the manager reach its decisions? And how did the manager vote on specific controversial matters in the past? And we talk about stewardship voting, and then but then if we want to kind of assess the effectiveness of engagement or stewardship can be a little bit harder for a kind of reasonable time frame, unless you stretch the time frame to say multiple years, because engagement is a long-term thing. It's hard to see the effect in a short period of time. Right, now come number 4. Explain the different client types and their objectives, which influence the type ESG investing strategies selected. If you go to the notes, there's Exhibit 5, the details are there, but then I kind of want to summarize several kind of common observations, general comments. And first one is about fiduciary duty. Pension funds or either defined benefit or defined contribution are traditionally charged with the highest fiduciary duty. Hence, fiduciary duty is a primary driver for ESG investment for pension funds. And reputational risk consideration is the primary ESG investment driver for sovereign wealth funds and foundations, which typically do have external investors, because unlike say pension funds, the funds are kind of managed on behalf of members, but then pretty much sovereign wealth funds, the country is the only investor, and then foundation, is kind of a fund for charity purpose and for a particular company, so there are no external investors. So in these cases, reputational risk is actually a primary ESG investment driver for these two kinds of investors. And then kind of also because the money is all proprietary money, these investors also have high tolerance for illiquidity and short-term underperformance. And general insurance. General insurance is a bit special in the sense that The ESG impact to a general insurer is mainly physical damage impact on claims or the physical damage to climate change. And because, well, for a general insurer, it must have sufficient resources to pay claims, so the main investment objective will be tilted towards loss aversion. In terms of investment horizon, pension funds and life insurance companies tend to have long investment horizons, but that's not, that may or may not be the case for other investors. Or should say that, well, for other investors, well, they normally do not have a liability target to match. And then say for general insurance, well, normally, well, the liabilities are very short term, so say the insurance policy may be 1 year, so the claims are supposed to happen, say within the year or shortly after the expiry, after the term of the policy. But then for pension funds and life insurance companies, they have long-term liabilities to match. And then in terms of the ESG approach, in most cases, that is mostly integration, except foundations, which may prefer exclusions to match founding or charitable aims. Okay, learning outcome number 5. Explain the key mechanisms for reporting on and monitoring performance and mandate alignment with client objectives. While manager performance is usually assessed regularly, the challenge is to avoid the manager becoming more short-term, while ESG concerned investment is long-term focused. So this is a point that we actually covered at the beginning of this chapter, and also I remember in previous chapters. So in terms of monitoring, the focus should mainly be on managers' culture, and a failure to adhere to the expected investment process and style should hence give rise to concerns, rather than a short-term underperformance against a benchmark. And notably, the Brunel Asset Management Accord emphasizes that short-term underperformance is not in itself likely to give rise to undue concern for the client. And it says investment performance, particularly in the short term, will be of limited significance in evaluating the manager. Right, explain the key mechanisms for reporting on and monitoring performance. And under the Brunel Asset Management Accord, well, short-term under or overperformance, outperformance is not the main source of concern, but then the Accord has listed down a number of aspects that we focus on. And overall, the focus should be on culture and conflict, so that will include, say, persistent failure to adhere to Brunel's investment principles and the spirit of the Accord, a change in investment style, or investments that do not fit into the expected style, lack of understanding of reasons for any underperformance, and or a reluctance to learn lessons from mistakes. Conversely, complacency after good performance should also be avoided. Failure to follow the investment restriction or manage risk appropriately, including taking too little risk, and then organization instability or the loss of key personnel. And well, apart from the Brunel Accord, there's also this RCGN model mandate, which asks for early reporting of the following things, some of which I will say telltale signs. And the aim is to monitor consistency of approach. That's the fund manager approach with mandate and the observations that were demonstrated in the due diligence process. So things like portfolio turnover and explanation for turnover outside the expected range, any change of governance ownership structure of the manager or in his investment approach or risk appetites, any regulatory investigation or legal proceedings, any change in staff ownership of in the funds under management or in the manager itself, regular financial accounts of the manager, any changes in or waivers of the manager's conflict of interest policy, any additional conflicts that have arisen over the reporting period. Right, key challenges in measuring important ESG-related investment performance. So there are two aspects. One is, well, the attribution of returns to ESG factors. It can be hard to demonstrate the value of engagement within a short period of time. And the other will be the report of ESG integration stewardship activities, but then there are guidelines from PISA and ICGN. For PISA, which is, well, the Pension Lifetime Savings Association, it's got a disclosure guide for public equities for reporting of ESG integration and stewardship activities. So the first one is identification of ESG risks and opportunities. For example, examples of where and why the manager is prepared to take either stock or sector ESG risks, or where it sees opportunities. Quantitative or qualitative examples of material ESG factors are identified in fundamental analysis and stock valuation. Identification of long-term ESG secular trends and themes as potential determinants of future growth of valuation, etc., and the extent to which they have influenced portfolio construction decisions. The management and monitoring of ESG risks and opportunities with suggested possible disclosures in respect of each. For example, a stock level ESG analysis for top risk and performance detractors or contributors in the reporting period. And any material changes to portfolio companies' ESG performance. For examples may include where the manager's view of ESG risk and opportunity differs from the market or rating agencies. And there are disclosures requested by ICGN model mandate. The first one being managers' assessment of ESG risks that are embedded in portfolio, what they are and how they are identified, monitored, and managed. And also detailed disclosure of stewardship, engagement, and voting activity. Okay, thanks for watching. Good luck to your exam.